another video on candlesticks trading patterns. So in this video tutorial, I'm going to show you the different types of candlestick patterns. If you haven't watched the previous video, I recommend you first go and watch that other video before you come to this. This is a bit advanced. We have the open, we have the close, we have the body, and then we have open, close, the body, the high, and then also we have the low. Now in this video tutorial, I'm going to show you the other patterns the institutions use in trading. How do you read the market? How do you trade candlestick patterns and take the money home? So why are these candlesticks important? So these candlesticks, you see the candlestick patterns that form on the chart. These candlestick patterns, we already saw how to identify them. We said these candlesticks tell a story and they are a reflection of what buyers and sellers are doing in the market. So you as a trader, you identify a pattern and then make a trading decision based on what the pattern is doing. Let's say you identify this is a gold spot chart. You identify gold is in a downtrend. Then you see a morning star pattern and you take buys. When you see it gives you an inside bar, you take sales. When you see gold giving you any pattern it forms, you make a trading decision off of that trading pattern. But there are other ways we use these patterns in order to come up with a good edge. So today I'm going to share with you the best ways you should trade those patterns. Now, to start with, we are going to look at what we call the long wick candles. The long wick candles. Now, here in the advanced way of trading candles, the long wick candles, we want to see price. Let's say you have price, which is in an uptrend. You have this. You also have this. You have price that is moving in an uptrend, and then you get a candle which has a long wick sticking out in the opposite of the moving trend. This is a long wick candle. The same thing can apply to a downtrend. By now, I'm sure you know how these patterns form, even if I don't go into deep. So you have a candle that forms of this pattern that forms with wicks sticking out on both sides. So the most important thing is to see a wick. It doesn't matter which kind of pattern you've seen. So you want to see this candle with wicks sticking out. So let's say if you have this and this one here, these two, we shall say candles with wicks sticking out. So these candles, you have candles with wicks sticking out. What does this market tell you? So in this advanced way of trading these candles, we say this is what you do. Read the candlestick pattern. Read the candlestick pattern and then come up with a price action trading psychology. It should tell you a trading psychology of why it has formed. And then if the trading psychology, the price action psychology of why it has formed is vivid enough for you to take the trade, then you go ahead and take the trade. Let's say, for example, you have such patterns, you come across such a pattern. What does this pattern tell you? This pattern tells you as price was going up, you had a candle that opened and pushed higher, but this candle was rejected. Let's say there was a strong rejection. This candle would have closed bullish like these others, but there was a strong rejection by the sellers who are willing to push price lower. It also tells you there is a lot of profit taking by the buyers. So you have this candle which opens, pushes higher. This long wick simply tells you we have selling presence in the market. So we have sellers stepping in. We also have buyers. These buyers you're seeing taking profits. It also indicates profit taking by the buyers. Profit taking. So if these buyers who pushed price of an asset, let's say from here to here, and you see such a candle, it tells you there is profit taking, sellers are stepping in, and this can easily cause a reversal from an upside to the downside. If you remember in the previous teaching, we said this is a shooting star, and we said this was a hammer candlestick pattern. So here we are saying we call them long wick candles. The same thing applies to this. You can have price push higher, have price push higher, price is pushing higher and higher. Then you get a candle that opens here, it pushes price up, pushes price up. So this same candle gets a rejection. Now, when this candle gets a rejection, it comes and pushes lower. So what happens? When this candle pushes lower, it's going to be bearish. So later on, because it is an uptrend, buyers again pushes it higher. Buyers step in to push this price higher, and it closes like this. If you remember in the previous teaching, we said this is a doji candlestick. We shall call this a long wick candle. This still falls under long wick candles. The same thing in a downtrend. You have price come in a downtrend. Price does the same thing as it is approaching a level. It gives you a candle that opens and pushes lower. This candle pushes lower. But when it pushes lower, it gets rejected. Because you see, in trading, there is buying and selling. Or price is too cheap for the buyers, they push price higher. This is what happens. This candle is going to become bullish. It will be bullish. So when this candle is bullish, it comes and closes here. It can close as a bullish candle or it can close as a bearish candle. Regardless of the color, it doesn't matter. All we want to see is a long wick candle. So this also still falls under long wick candles. And what does it tell you as a trader? Buyers try to push price higher and higher, that failed to close this candle as any other candle, as a momentum candle or as a normal candle. But instead, sellers stepped in and also swung price down, causing it to close as an indecision candle. So it is indecisive. But when it occurs at a key level, it simply indicates, when you see this, it simply tells you there is profit. If it is in an uptrend, these buyers who pushed price here, they are taking profits. And if it's in a downtrend, the sellers who have been shorting this market, they are now taking profits, and buyers are stepping in at this point, sellers are stepping in. So that is how we read these candlesticks. I repeat, long wick candles. We now here in the advanced way, we don't say this is a doji, we don't say this. All we want to see is a long wick candle forming at a key level. It can be a support level, it can be a supply and demand level. Then we go ahead and take action of what it has done. Don't forget, it indicates profit taking. If it is an uptrend, sellers are stepping in and buyers are taking profits. If it's in a downtrend, sellers are taking profits, buyers are opening up new positions. We also have inverted long wick. Inverted long wick candle. Let's say price is in an uptrend. You see price is back, and then suddenly this candle opens. Instead of pushing higher to make a higher, we get a sudden selling presence that gets into the market. So after that, buyers will again step in and you have a candle closing with such an appearance. These ones can weak candles. A good candle should always have this happens when price approaches a supply zone or a demand zone or a resistance level, and you are in a downtrend. You may have something like this. So you have price pushing lower, and all of a sudden, instead of this candle opening and pushing lower, it opens and you get a sudden spike. Buyers stepping in, suddenly spiking and getting into the market. And later on, sellers push price. So you have a candle closing in this format. In the last video, we said this can be regarded as a hanging man candlestick pattern, and then this one is an inverted hammer candlestick pattern. In the advanced way, we say this is an inverted long wick candle, or you can just take it as a long wick candle. What is the price action? What is the trading psychology tell you? That is the most important thing. You don't have to cram it as an inverted hammer. You don't have to cram it as a shooting star. The most important thing is to understand the price action psychology of why it has happened. Which trading psychology does it tell you? You observe, you have wicks sticking out in the opposite direction of the moving trend. So you have these wicks which stick out in the opposite direction of the moving trend. This is coming down like this, and then you have this move where price is going up. So you then have candles with wicks sticking out in the opposite direction of the moving trend. What does that tell you as a trader, as someone who is trading candlestick patterns? So number one, it tells you that when price reached this level, you had a sudden selling presence that stepped in for the case of an uptrend, and for this downtrend, you had a sudden buying presence that stepped into the market. Now, this one causes these wicks to stick out. It causes the wicks to stick out, and it validates that this key level you're seeing is of interest to the buyers for the case of this one. And this one, this key level you're seeing is of interest to the sellers. I repeat, when price was approaching this level, you had a sudden selling presence that entered into the market. It tells you this key level is of interest to the sellers. And in a downtrend, when price approached this level, you had a sudden buying presence that entered the market. This tells you this key level we are on is of interest to the buyers. So you will have sellers closing their positions and the buyers looking forward to open up new positions. And you make a trading decision based on this. So you don't, even if you don't trade this candle, but at least you can tell what the next candle is likely to do. So that is how we trade these candles in the advanced way. We said this can be seen as a hanging man and this as an inverted hammer. But if you cannot cram those names, just know we call them long wick candles. These are long wick candles, inverted long wick candles. We have these long wick candles. Now this other candle can also close like this. Can also have something like this, and you can also have something like this. Okay, let me just do it afresh here. We are here to learn. We are here to learn. You have a candle that is push. You have a move, a momentum, which is going bullish. You're going bullish. You're going bullish. And then you have this candle opens. It pushes higher, forming a bullish candle. Later on, because it is at a key level, sellers step in and push price lower. They push price lower, giving you this. Then buyers flex their muscles and push price up again. You're going to form, if this candle closes, it will have such a pattern. Now, this is also a long wick candle, but let's say this candle closes like this in favor of the seller. It still falls under long wick candles. That's why I said don't cram. Try to understand why these patterns form, and you will not have problem with trading. You have this candle that pushed lower all the way up to down. It became too cheap for buyers, and price was pushed up. So when price is pushed up, it's going to become bullish. Now when it becomes bullish, again sellers push it lower, and let's say it ends up closing like this. We shall go to the charts and see these things. So this is also, we can call it an inverted long wick candle, or you can just call them long wick candles, not to confuse yourself. Even if you call these long wick candles, the most important thing, you have long wicks sticking out on the candles. So the same thing here, it tells you buyers pushed price higher, sellers pushed price lower. Sellers pushed price lower, buyers stepped in and pushed price higher. So this indecision shows profit taking and opening up of new positions as as traders are seeing interest in this key level. So the double action of buyers opening up new positions here and sellers closing new positions is what is likely to give you a possible trend reversal. And the double action of buyers closing their positions here and sellers stepping in to push price to open new positions is what is likely to give you a possible reversal. So these, we call them long wick candles, and we want to see them form on a key level. Let's say this is a monthly level or a weekly level. You look at price action which is taking place and you make a trading decision. This can happen on the daily, it can happen on the 4-hour, it can happen on the monthly, it can happen on the weekly, just as I will show you how to trade these patterns. Let's look at another pattern, which is multiple long wick candles. We are still looking at candlestick patterns, but how we trade them as interlight traders, the advanced way of trading them and seeing these patterns. How do we read the market using these patterns? So multiple long wick candles is when you have price react to a level. Let's say this one is, you have price which is pushing, and then you encounter a level. You encounter a level here. You have price come and give you a wick here. Price again opens, tries, and it fails. It is pushed lower. It will close like this. If you remember how candlesticks open and close, train yourself to see these things. Let's say maybe another candle opens here, pushes price, but it gets rejected and pushes lower again. These are what we call multiple long wick candles. You have many candles forming at the same level. We shall see these things, all of them, how they happen, how they have been forming. This can be even a doji. It can be any, but as long as you have candles with wicks sticking out, we call them multiple long wick candles. And you as a trader, when you spot this, these are always high probability reversal trades. We are looking at multiple long wick candles. You don't have to cram these things, just understand them and why they form. You will have no problem with trading. You have this, then you get this candle rejecting. Another candle opens from where this closed, and maybe it pushes lower. As it pushes lower, it gets rejected. So when this candle flips bullish, buyers step in and it closes as a long wick candle. The same candle opens here, pushes down, will be bearish. This is a bearish candle. This one. Buyers step in and push this price higher. So these wicks, when you have candles with wicks like this, we call these multiple long wick candles. And what does this tell you as a trader? This simply tells you that price tried over and over multiple times to break a level, but failing. If you have these candles forming at a level of support or resistance, this price has tried multiple times to break above here, but they have failed. The same thing applies to a downtrend. sellers have tried over and over 3 times to breach the level, to break lower, but the buyers are holding this level strong and they are willing to open up positions to push price back. Here you see buyers were in control. They tried the first time to go up, they were pushed lower. The second time, they were pushed lower. The third time they tried to push higher, sellers rejected. So as price approaches this key level, we see buyers are taking profits and sellers are willing to open up positions. So this tells you the level you are on is of key interest to the buyers, to the sellers and buyers. You will have buyers wanting to close their positions and sellers stepping in. And one thing you need to know is these sellers are holding the level strong. They are willing to push price lower. So you will always have such patterns form, and if you can understand the price action psychology of why they have formed, you have no problem with trading. Price is in an uptrend. You then have multiple candles, multiple long wick candles form at this level. It tells you that the buyers are taking profits and sellers are holding this level strong. They are willing to open up new positions. Now, it doesn't mean because you have seen such a pattern that the market is going to reverse. At times, it can form and then continue up. But there are other things that we use in order to make a trading decision off of this, as we are going to see in the future. Then we have also this. You see sellers are pushing price lower and buyers are holding the level strong. Sellers have tried 3 times to break lower. Buyers keep opening up positions. So this tells you the area you are in is of key interest to the sellers. The buyers, they are willing to open up new positions to go to push price higher. So that is what happens. You can have multiple long wick candles. You can have doji candlestick patterns form here. You can have hammer candlesticks, inverted hammer candlesticks. You can have price do this. All I want is for you not to cram these things, because if you have price come down, price is pushing lower, price is pushing lower, then you have a sudden spike of price pushing high, and then you have such kind of a candle that forms this one. The same thing happens, this candle opens, it buys, then maybe it is again pushed lower. So this candle closed as a bullish candle like this, and then you have this one which is being rejected and closes bearish with a wick like this. The reason why I'm teaching you variety of this is because you will always see these patterns form. Then you have another candle that opens, maybe it pushes down, and when it pushes down, it gets also rejected. You have it open and close like this. So these are still long wick candles. Long wick candles. As long as they have candles with wicks sticking out on their sides, we call them long wick candles. So our goal is to read price action in such a level and come up with a decision of what we are going to do next. So the same thing applies in an uptrend. You can have price in a strong uptrend. Price is in a strong uptrend, and you have these kind of patterns. Let's say you have these patterns form here, these ones. You can have these things form. All you need to do is to read price action, what it is telling you, and you make a trading decision of what is taking place. So these are still multiple long wick candles. So you as a trader, when you open up your charts, be it on the monthly time frame, be it on the weekly time frame, be it on the daily time frame, be it on the 4-hour time frame, and you see such forming, it should communicate something to you. If you understand them, you don't need to cram the names in order for you to make a trading decision. So all those are multiple long wick candles. So if you are to use the other previous teaching, you will say you have a doji, 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 doji. You have this hammer candlestick pattern, which is okay. But in this advanced lecture, in this as an interlight trader, I want you to understand the trade psychology, the price action of why it is formed. Another pattern that we have, a candle color change. You have price is moving in an uptrend. You have price moving in an uptrend, and then all of a sudden you get a candle color change. This is a candle color change. In the previous teaching, we said this is an inside bar, but you can also have price form such a pattern here. It gives you a candle color change. Now let's say this time it forms like this. If you are following the previous teaching, you will say this is maybe a different candle. But here, in the advanced way, we say, instead of you saying an inside bar, we can say a candle color change. If we go back to this, you had all green candles before you had a candle color change. You had all red candles before you had a candle color change. So this communicates to you, this speaks to you as a trader, and it tells you that there is momentum loss in the market. The same thing applies to a downtrend. You will have price that is pushing lower and lower and lower. All of a sudden, you have a candle that opens and it closes as a bullish candle. So this is a candle color change because you have all green candles before you have all red candles before you have a green candle. In this uptrend, you have all green candles before you had a red candle. So it tells you this. First, we said it is a candle color change. Candle color change pattern. So these are also candlestick patterns, but the advanced ones. Instead of you going to cram the names of candlesticks, just know this is called a candle color change. And once you have this candle color change taking place at a key level, it can be support or resistance, supply or demand, then it tells you there is momentum loss in the market. So you have this market which is pushing higher, and then you have a candle color change that forms at a key level. It tells you there is momentum loss from the buyers, and because this candle failed to close as a bullish engulfing candle, it didn't give you a higher high, so it tells you there is momentum loss from these buyers, and they are no longer in control of this trend, which is an early signal of a possible trend reversal. I repeat, you have price which is pushing price higher and higher and higher, and then all of a sudden you get a candle color change. It shows momentum loss from these buyers since they fail to push and close price as a higher high. Instead, it gave you a candle color change. So these buyers are no longer in control of this trend, and it is an early signal of a possible trend reversal. The same thing applies to this. Here, you are in a downtrend. See, price is selling strongly. Let's say you identify these candles on any time frame, and then you get a candle color change at a key level. These candle color changes. Then after that, you will have a possible reversal as an early signal. Why? These sellers have lost control. They are no longer in control of this downtrend. This candle color change tells you momentum loss. So you expect a possible trend reversal. The same thing applies to this. You have all green candles before you have a candle color change. Buyers are no longer in control of this trend. Sellers are likely to step in. It is an early signal, but it's not a confirmation. Sellers are pushing price lower. You get a candle color change. Sellers are no longer in control of this trend. Buyers are willing to step in. Loss of momentum, profit taking, no longer in control. And see what happens. Buyers can step in and push price higher. So the most important thing is for you to understand the price action psychology of why it is happening. What is the psychology behind this candle color change? Buyers are no longer in control of this trend, and this acts as an early signal of a possible trend change. Sellers are no longer in control of this downtrend. This candle color change acts as an early signal of a possible trend change. We shall see these patterns on the charts. If you can understand the psychology of why they form, you will have no problem with trading. So let's look at, we have what we call shrinking candles. When it comes to shrinking candles, you understand as price is moving, if this is an uptrend, you will have a big candle. Let's say you have a huge bullish candle here. Then the next candle travels a small distance. Then you have this other candle travel another smaller distance. And then you have this one. Let's say these candles have wicks. They have wicks. They have wicks. And then you have this. So These ones, we call them shrinking candles because here you had a candle that traveled a longer distance. In terms of price, you see there was huge momentum. This is what we call a most bullish candle. You then had a normal bullish candle. You also had a normal bullish candle. And again, you had this normal bullish candle. But when you look at their candle body shapes and sizes, they are becoming smaller and smaller and smaller and smaller as they approach this key level. So this tells you there is momentum loss from these buyers. There is momentum loss from these buyers. And because there is momentum loss from these buyers, this can cause a possible trend reversal. Because as price is approaching a key level, you see it is losing steam. Buyers are getting out of the market as price approaches this level. This is what we call shrinking candles in an uptrend. So this acts as an early signal of a possible trend change. So we don't trade these patterns on their own, but we trade them in confluence with others, as we are going to see. Then you can have the same thing in a downtrend. Price is pushing lower. Price is pushing lower. So here you have a huge bearish momentum candle. This one. This is a huge bearish candle. Then you have this other candle. Let's say it forms this. You have this one here. Let's say it forms this. But you see, as these candles approach this lower level, they become smaller and smaller and smaller. So this tells you there is momentum loss because as price is approaching this level, sellers are stepping out of the market. Sellers are stepping out of the market. There is a lot of profit taking here. That's why you see these candles form. So momentum loss, and they tell you there is profit taking. So this can easily cause a reversal. But we don't just enter because of this. We wait and see other price actions. Read price action. We wait and read the price action taking place, and then we make a good trading decision. But you, as someone who is learning from me, as interlight traders, when you see such a move approaching a level, it should tell you in your mind that a possible reversal is likely to happen. So these are called shrinking candles. Momentum loss, and they can act as an early signal of a possible trend change. So here you have a big candle, a smaller candle, another smaller candle, and even smaller candle. You have a big candle, a smaller candle, another smaller candle, and even another smaller candle, which shows momentum loss. Then the opposite of shrinking candles, them growing candles. Here, under growing candles, you have price moving. If it is in an uptrend, as price, let's say, as price is going up, the distance traveled by the candle keeps becoming larger and larger and larger. So you as a trader, when you see such kind of a move, you don't have to trade against it. You have a small candle here, which is a bullish candle, and then you have a bigger candle, another bigger candle here, and even another bigger candle. So you see, as price approaches the level, you're seeing price moved from this level here. It started small, then you got another big candle, you got another big candle, and you got another big candle. So this tells you there is gain of momentum as price is going higher and higher. So we call them growing candles. So you have these candles where the body sizes are becoming bigger and bigger. So this confirms that buyers have stepped in and they are willing to push price higher and higher. The same thing applies in a downtrend. You can have price start small when the candle is very, very small. These candles are small, but as price keeps on, the candles keeps growing and becoming bigger. Another candle opens, it grows and becomes bigger. Then another candle opens, it grows. So the candle body sizes and shapes keeps becoming bigger and bigger and bigger as price continues to go down. So these are called growing candles. You don't need to trade against this kind of candles. These candles can occur, they can form on the monthly, they can form on the weekly, they can form on the daily. But as long as you see these candle body sizes and shapes are becoming bigger and bigger, we call them growing candles. So they confirm a heavy selling presence in the case of a downtrend and a heavy buying presence in the case of an uptrend. If you see this after such patterns, let's say you had shrinking candles and then you get growing candles, it is a good signal for you to go ahead and make money from the market. The other type of candle that we have to look at is what we call momentum candle. So a momentum candle, just as the name suggests, is one whose body size is bigger than the previous candle. If you remember previously, we said you can have price, let's say price is moving in the up, price is in an uptrend, you have price that is moving up like this. It is in an uptrend. You have wicks that are forming and then price approaches a level, it opens, it goes up, and then you have a strong selling pressure. Now we call this an engulfing bar in the previous teaching. This is a typical example of an engulfing bar. But what if you have a different type of candle? You have bullish candles, you have bullish candles, yeah, you have bullish candles, you have candles that are buying, and then you have a candle that shows some selling presence in the market. Then this candle forms, let's say, somewhere here, and after that you get such kind of a pattern. The market opens, it goes up a little bit because we said if it goes up it will be bullish. This will be bullish, and when it goes up it's going to be bullish. Then later on this candle flips bearish. See a strong selling presence that steps in here, and you get a strong selling move to the downside. So what does this tell you as a trader? This strong selling presence you're seeing here comes in as a result of momentum having stepped in. So this, previously we said this is an engulfing bar. This is a typical example of an engulfing bar. But this one, we call it a momentum candle, one whose body size is bigger than the previous candle. So you can call this a momentum candle. You can also call this a momentum candle. Or we can call it a momentum engulfing candle. Engulfing candle. The most important thing here in trading, all you need to is to understand the psychology of why they are forming. It's not about cramming the names, even if you cram the name. So you have the candle body size, which is larger than the previous candle, and it indicates a heavy gain of momentum. So if it is in an uptrend, it is going to confirm a lot of sellers who have stepped in at that level. And this creates a strong bearish momentum, causing a reversal. So this is used as a reversal trend change pattern. If you remember of trend change patterns, those who have been studying with me, if you haven't watched that video of trend change patterns, you go back and watch it. So if price has been moving in an uptrend and it encounters a key level, you see such kind of a pattern, it's a good signal for you to get into the trade. The same thing applies to a downtrend. You have price which is pushing lower, price is pushing lower. You can have a sudden spike of a huge bullish candle, but at times you may not see this. Instead, what you will see, you may see such kind of a pattern for me. This one. In the market, we say there is buying and selling. So price doesn't just form, it takes time. But you as a trader, you read the price action and act based on what you're seeing. So if you find such a candle when the market has already given you this and you see this, it is a signal for you that there is a possible trend change. If you remember in the last teachings, the morning stars, what, you can now see them. We use them in a different way. This is advanced because I don't want you to cram the names. Simply understand why price action forms. If you have a move where you have all green candles, then you have a candle color change. You then have a huge bullish momentum candle that is larger than this. This tells you that the increase of buyers who are willing to push price high. So when you have a candle body size larger than this previous candle, It confirms a lot of buyers have stepped in, creating a strong bullish momentum, and it can cause a reversal. This can happen on the daily time frame, on the monthly time frame, on the weekly time frame. The other candlestick pattern I want you to know, being as an interlight trader, is what we call a gap up, and gap down candle. This is a gap up and a gap down candle. Now, this candle can also be used to tell a trend reversal. So let's say you have price that has been moving bullish. You have this market has been going up and it is approaching a key level. When price reaches here, it does this. We expect, because this candle opened here and closed above, and we know green candles open at the bottom and close at the top. So we expect this candle to open and continue to push higher, to give you higher highs and higher lows. This is what we expect. But then this candle doesn't do this. Instead, what it does this. This candle opens from somewhere down. You get price opens, instead of opening from there, it opens from down here and continues to trade lower. When you see such kind of a candle, all you do is mark the previous day's closing price and the new day's opening price. This one here. And then the distance, the range between these two candles here is what we call a gap. The range in between these two candles is what we call a gap. So you have a gap down, you have a gap down candle. This is a gap down. This one we call it a gap down. So the rule is, the moment you see this candle, mark the previous day's candle, previous day's close, mark the previous day's close. So mark the previous day's close, which is this, and the new day's open. The new day's open. So when you mark the two, the range in between this previous day's close and the new day's open is what we call a gap down. And if this happens on the daily time frame and at a key level where price has been in the past, we say this is a trend reversal, because this one indicates there is a sudden profit taking and a trend change is taking place. Now, at times, these gap down and gap up candles, they occur as a result of news release, especially outside of the regular trading hours. But if you get to see this on a key level, then just know there is a possible trend change and price is going to continue selling in that direction. At times, price will do what we call a gap fill. Gap fill is where price opens here. If it can go back and fill the gap such that the price balances, because when price doesn't balance, in the future we shall see that the market always moves while balancing. Price moves while buying, selling, buying, selling. So price always goes to balance. But for now, all I want you to know is gap downs will occur. If it is in an uptrend and it is occurring at a key level, price can gap up, it can gap down. And the same thing can happen here, where you have price gapping down into a key level. Let's say you have price is pushing lower and lower and lower, and then the next day you find price has gapped down. It gaps into a key level when price was still up here. If you mark the previous day's closing price, which is this is the previous day's closing price, the new day's opening price, you're going to have this imbalance, or you're going to have that gap. Now, when there is a gap down into a key level, it means this asset gapped down, it priced itself cheaper, and there is a possible trend reversal. This is also a gap down. Mark me correctly, don't misquote me. We have the previous day's close here. Price gaps into a key level when it has not reached the level. It gaps into the level. And this is the new day's open, which is this. This price gapped into the level to be bought. And after them buying, you will see price can give you a possible reversal. Or it will come and do what we call a gap fill, such that it is fairly priced. So if this price does gap fill, then if what caused price to be cheaper here was irrational based on emotions or based on manipulations, price will fill this and then it will continue down. set fills and continues down. But if what caused this price to gap down is something which is to force price to reverse, it gaps down to be bought, and then the price of an asset will go higher. Here you have a gap down acting as a trend reversal where price is overpriced, price is overbought, and then it gaps down, showing a lot of profit taking. Here you have price when it is in a downtrend, price it gaps down to be oversold, and then it buys, or it does what we call a gap fill. The same thing applies in the opposite direction. You can have candles, these ones, have these candles. You have these candles here. Price is in a downtrend. Price is selling here. And then the next day, you wake up to see a candle which is like this, creating a gap. We said you mark the previous day's close, and the new day's open. So if we mark our previous day's close and the new day's open, we are going to have this. This is our previous day's close, and then this is our new day's opening price. Previous day's closing price, then this is the previous day's closing price. Then this is the new day's opening price. These things can be a little bit confusing, and that's why I'm here. So this is called a gap up. This is called a gap up. Now this one, at times you may see price coming to balance and then it goes up. But if you don't see price coming back to balance here, it will just continue trending, printing candles, bullish candles, because price came into this level to be bought. It was over, price came into this level. The ones who were selling, the ones who were shorting the market, they pushed price here. There was opening of new positions in this level, and then closing of positions also took place. So this is what we call a gap up. Then if price is moving in an uptrend, you see up down like this. So we said you mark the previous day's close and the new day's open. So the gap in between the two gives you what we call a gap down. The market can go back to fill the gap, or because this candle opened here, we expected another candle to open and continue higher. So if the market opens and if this candle opens and it goes back to fill this gap, we call that a gap fill. So you can expect a gap fill to occur in such candle patterns. Let's look at the next candlestick pattern. We have what we call a candle combo pattern. And just like the word itself, if you know the meaning of combo, this candle opens, pushes higher, it comes and closes like this, giving you a hammer candlestick pattern. You then have, this is already one where we say these are shrinking candles. Then you have price opens, goes higher, it gets rejected, and then price pushes lower. A candle combo is when you have more than one candlestick pattern at a key level. You have more than one candlestick pattern at a key level. Let's say you have that price is in an uptrend. Then you have a big candle, a smaller candle, and another smaller candle as price is approaching. Let's say if we combine any of those candlestick patterns we have learned, now here, let's say you get this candle that opens, of course it will be bearish, and then it goes and closes like this as a long wick candle. But after having moved up and down, then you have another candle that opens here because this was bullish. So you push higher, then you push lower. You have a candle closing as a momentum candle like this. So if you look at this, how many candlestick patterns do we see here? You have what we call shrinking candles. You have shrinking, candles, shrinking candles. One, then two, you have multiple long wick candles. You then have candle color change. You also have long wick candle. Then have momentum. So you realize on just one candle pattern like this, you have shrinking candles, you have multiple long wick candles because price tried here the first time, tried the second time, then the third time. So you have three long wick candles, they form multiple long wick candles. You then have a candle color change at this level. You have a long wick candle, which is a good price action, especially when price is at a key level like this. You then have a momentum candle, which confirms a bullish, a bearish bias. So when you have such kind of patterns forming at the same level, just like as we have seen, this move has a combination of 1, 2, 3, 4, 5. So we call this as a candle combo pattern. Candle combo pattern. Now, a candle combo pattern, it increases the confluences of price going in your direction. it increases the confluences of price going in your direction. The same thing happens in a downtrend. We have seen combo pattern, we have seen gap down candles. How this one, especially if you are someone who trades stocks and cryptos, you need to understand gap down and gap up candles. We have seen a momentum engulfing candle. We have seen growing candles. We have seen shrinking candles. We have seen candle color change and very, very many other things. Let's go to the charts. When we come to our charts, we are going to be referencing on what we have just learned. If you look at this candle, you see price here was selling here. This was, it's a downtrend. Then you have multiple long wick candles that formed at such a key level. See this? These are multiple long wick candles. This is a gold chart. This is a gold chart. We had rejection 1, rejection 2, rejection 3, rejection 4, rejection 5. So price tried 5 times in total to push price below this. These are 5 days worth of trading. 1 full week, price is at this level, but failed to close below this level. So this shows how strong the level is to buyers and sellers. Sellers are willing to close their positions here, and buyers are willing to open positions. Sellers come and close, buyers step in. So these ones, we call them multiple long wick candles. Multiple long wick candles. Why? Because you have very candle wicks sticking. Now, in the previous class, we said you can identify this as an inside bar. You can identify this as a doji. You can identify this as a doji and take trades of what the market is telling. But here in the advanced way, we say when you come and open your chart, you realize price has given you such kind of price action. Price has tried the first time, it failed. The second time it tried lower, it failed. The third time it failed. The fourth time it failed. The fifth time. This tells you this level is of key interest to buyers and sellers. Those ones, we call them multiple long wick candle. Then we have also price. Price is reacting to this level you're seeing. This is a long wick candle. We also have a candle color change. We have all red candles before having this green candle color change. So you have a long wick candle here, and you also have a candle color change. So one, you have long wick candle, and then you have candle color change. We can also say this candle also tried to push lower, but it got rejected. So this can qualify to be a candle combo because we have 2 candlestick patterns taking place at the same level. This can also be said to be multiple long wick candles because we have rejection 1 here. Also it tried, it got rejected. The third time it tried and it got rejected. We also have multiple long wick candles here. We have these as long wick candles, long wick, candles. Previously we said this, you can call it a bottom twist, but now here we say call them long wick candles. We have multiple long wick candles here. So which patterns do you see here? One is shrinking candles, because we have a big candle, a small candle, and another smaller candle as price approaching here. Two, we have long wick candles, or we can say multiple long wick candles. Then we have candle color change. And then you have growing candles. As price is coming down, you have growing candles. These are growing candles. Now, all these ones here, these candlestick patterns, they form what we call a combo. So when you have more than 3 patterns forming at such a level, they form what we call a candle combo, because this level had already been respected in the past. And you can see what the market did. The whole of this move started from there. So this is a gold chart on the daily time frame. You will go and check the same thing. It was 12th May, around 8th May 2026. So this move, after seeing a combo, this is what happened. We have here a candle color change and then a momentum candle. What did the price do? Even if price went back, but it pushed low. This is a momentum candle. Then we have this also as a momentum candle. This is a momentum candle, this candle here. Why? Its body size is bigger than this previous candle. We have multiple long wick candles here. These are multiple long wick candles, multiple long wick candles. So these are multiple long wick candles. This is a momentum candle. This one is a momentum candle. We have a momentum, a bearish momentum, candle. This one is a bearish momentum candle. Now, this is an example of long wick candles. See, these are long wick candles. But later on, price broke above and continued up. Why? Because we said price can form these patterns, but you need to see a confirmation. Even though you have shrinking candles, long wick candles, it doesn't mean these patterns work 100%. At times they will fail. But you understanding the price action psychology of what is taking place is what matters. Because here we can see we had shrinking candles, multiple long wick candles, a candle color change. This shows momentum loss, but you didn't get any price action signal that said something like a momentum candle that the price is indeed going down. So we want to see a candle confirmation. We said a momentum candle confirms a trend reversal. So after seeing these patterns, you want to see a candle like a momentum candle forming to push price lower, because price can stall around a level, just like the way you see price formed this pattern here in this level, and it stalled around and continued going bullish. Why? Because price wasn't ready to come down. In the future, I will teach you a concept of seeing where price is coming from. If you can know where price is coming from, then it will also help you to go about false trade setup. So this one, we call it a false trade setup. And indeed, many traders here were taken out. We have this bearish momentum candle after these long wick candles, and you can see the effect of the trade. This is a ranging market. Here you have a ranging market, and notice each time price came to this level, when price came to this level here, you had an engulfing bar, or you had a momentum candle. This is a momentum candle, and see what price did. Price sold strongly. When price came to here, you had long wick candles or top traders, and price sold. Candle color change, price sold. You had a long wick candle here, so we don't consider this unless there is a level where price reacted to in the past and it gives you this. You can take it as a signal, but without a level behind, we don't consider this as a signal. Maybe it can signal profit taking, but in the middle of the trend, you can still have price stall around and continue bullish. Then you had this one, you had this move here, you had long wick candle, price bought here. With gold, this is a lot of money if you're trading gold. Then you had candle color change, price bought. You then had a momentum candle here. This is a momentum candle, and see what happened. Price went into a very strong bullish move. So this is how we apply these patterns to trade conservatively. You wait for a pattern to form and tell you where exactly the market is going to. These patterns work as long as you know how to trade them the right way. But if you don't practice them, if you don't give them enough time, they won't work for you. Maybe you can go ahead and trade other strategies, other stuff. But if you're a pattern trader and if you want to trade the market with peace of mind, then you need to backtest them and get to know how the market responds towards them.